Now let's talk about PTC India Financial Services. The stock is up about 1.5% and the company's MD and CEO Ashok Haldia joining us here on ET Now. Good afternoon, Mr. Haldia. The reason we're getting you here on the channel today is to talk about the future, considering solar tariffs have dropped to below the cost of coal-fired power. How is this going to impact the solar power demand? Have you anyway been seeing that go up? And in this low tariff regime, I'm sure the financials of power companies is going to be impacted.
The tariff of the solar power, as we have seen, has gone to 2.62 rupees, and it is not that it was unexpected. In fact, we in the PFS has been maintaining for many years that the tariff for the renewables and the solar in particular would fall steeply. So when the tariff fell to 2.99 or 3.30 rupees, we felt that the tariff might still go down further, and that's what precisely has taken place. So it's not surprising us in any manner. At the same time, when we are talking about the viability of these projects which have a bid of 2.62 rupees, we have to keep one thing in mind, that the tariff is one aspect of determination of the viability. The other key aspects that goes into this is the capex, the opex, the financial restructuring, and the IRR expectations. So all these four goes into, and together with the tariff, in deciding whether the project is viable or not. And then certainly together with this is the risk profile, and these factors are relevant to or specific to the projects and the promoter. So as I have been maintaining all along, whether the particular tariff is viable or not, this would depend upon the project and the promoter. And see, the implementation period is 12 months onwards. I'm sure those who have bid, would have spoken to their suppliers, their financiers, and that they would have some sense of reasonable assurance or the comfort that they would be able to supply the plant at a particular rate, and they would be able to obtain the finance at a particular with a particular structure and the interest rates, and only then they would, with their own IRR expectations, they would given the bid. When it really comes to the lenders, as a lender, we go into each and every aspect of this, and unless we are convinced.
Yeah, Mr. Haldia, I just hope they have figured it out right, because in the past we have seen projections go awry when it comes to the power sector. And that brings me to something else I want to ask you, that given this low tariff regime, how is it going to impact your collections and recoveries from the power companies? As well as if you could give us an update on the current NPA levels in terms of the breakup between the different power verticals.
The projects that we have financed in the renewables, we have financed more than about 115 projects, solar and the renewables, and our experience for the recovery for the in these two categories has been satisfactory. There has been delays from the discoms, as we have seen from time to time, and in different discoms. But of late, with the onset of the Udaya, there has been those states which were delaying. They have become far more. Delay has reduced considerably in terms of payment of dues to these projects. And remember, when we finance, we also look into the credentials and the capability of the promoters. So wherever there have been delay, the promoters chip in, and then they arrange some sort of a bridge funding. So while the delay takes place, the lenders' dues are paid in time. So I would say, as far as the wind and solar is concerned, our dues have not been, dues collection has not been a problem. Mm-hmm. Secondly, the projects that we have financed, almost most of them have achieved the commercial operations, and they have a PPA in place with the state discom. So, and we don't see any threat of the state discoms going back on those PPAs and now or maybe in future, and then putting those projects, their own credibility at stake.
Right. Mr. Haldia, can you tell us your view on the margins going forward for FY18? What will be the key drivers for your margin expansion?
No, as far as the margin is concerned, the yield and the cost. So there is a pressure on the yield in terms of the expectations of the developers and the renewable power projects, availability of liquidity in the market, and also the general reduction in the interest rates. At the same time, when that happens, the cost of borrowing also reduces. So we have seen over a period that while the yield is reducing, and if not with the same proportion and if not with the same time gap, the cost of borrowing has also been reducing. So we have been able, that's why we have been able to maintain our spread at around 3.25 in the first 9 months. And we believe that we should be able to maintain in the times to come both the, if there is a reduction in the yield, we should be able to bring the corresponding reduction in the cost of borrowings.